Moving on with our project in on fairbinaryoptions.com and into the Binary Options Academy, we are looking actually at some fundamental news and how to put them into perspective. On the first two projects dedicated to this series, you've seen that we've introduced the economic calendar in the first one, and in the second one what we've done is presented the difference, not the difference, the importance or the influence the CPI has on markets, or the inflation, if you want, has on markets. And basically on this educational series, I would like to show you the importance of central bank interest rates and how markets are actually moving based on that. Now keep in mind that whenever you look at the charts like this one here, for example, this is a euro US dollar for our chart, all these moves here, if you analyze the moves on the chart using technical analysis, that is one thing. But all these moves, all these violent moves are being let's say caused by economic events or things that they are happening, and they are happening at a specific moment of time. Now, for example, what I would like to show you here on the euro US dollar on the 4-hour chart, this was here, this was the CPI, Consumer Price Index, or inflation, was released in Europe, and this release has been last year in October, and the forecast, if I remember correctly, you can go and check on the economic calendar nevertheless, but the forecast has been, so previous CPI, previous value was 1.1%. The forecast was 1.1%. What is the forecast? The forecast is the average made by all these economists when they are being asked to rate the inflation level for the release, and then an average is being made and the forecast is being published. But the actual came at 0.7%. It was tremendous, let's say, impact on the market because keep in mind the mandate of the central bank is to keep inflation below or close to 2%. Now, while everybody knew that we had 1.1% in Europe and the forecast was, but 0.7 was threatening deflationary pressures, basically the consumer will stop spending, and that spells a lot of trouble for not only for the euro US dollars, this example is here, but for all the euro related pairs like the euro Great Britain pound, the euro Australian dollar, whatever you name it. From that moment of time, markets sold aggressively the euro dollars, you can see here, aggressively for more than 2 weeks. This is the rest of the week and then another week. Why? Because the most important thing everybody's looking when trading is trying to have an educated guess what the central bank is going to do when they are meeting at their monetary policy and what they are going to do regarding the interest rates. A lower value of inflation, or the CPI here, 0.7 on forecast of 1.1% and previous 1.1%, was virtually guaranteeing or leaning the odds for the central bank or for the European Central Bank next time they will meet to come and cut the interest rates. Well, next time they met here 2 weeks later, and what did they do? They come and cut the interest rate. This spike to the downside from 135.13 to 132.93 basically happened in virtually, I don't know, 10 minutes or stuff like that. So what I'm trying to say is that the CPI was here, the market position for the ECB to come and deliver a rate cut, and the ECB came and delivered the rate cut. The rate cut basically was the response that the central bank had to deflationary pressures, because whenever the inflation is going to the downside, the expectations are for the central bank to come and cut the interest rates, and this is being viewed as negative for the currency, because no one wants to own a currency that pays a lower interest rate. Therefore, you should go and trade put options, starting from here. Whenever the inflation is moving to the upside, then the expectations are that the central bank is going to come and increase the interest rates, and therefore everybody will buy that currency. Normally in this situation, everybody will go and buy call options on that currency or the currency pair, because everybody wants to own a currency that is paying a higher interest rate. This is just an example what this means. Stay tuned for the second part with more examples and how to interpret these central banks and their decision, the most important decisions that the markets are looking when setting a trade, regardless what you're trading. If you're trading only the spot market like the forex market, or if you're trading binary options, or if you're trading equities, bonds, and so on, they are all being influenced by central bank interest rate decision. Stay tuned for the second part here on fairbinaryoptions.com, please.